Hey, what's up, dividend growth investor? Mikey Hu here for Dividend Stocks Rock. I hope you are doing well today. Today, I want to review Costco and see the possibility of seeing this company crash in 2025. First, let's take a look at Costco's Dividend Triangle to tell you how much I love this company. And it's actually really easy to love because, as you can see here, the revenue keeps on going up. The earnings is actually following, and then the best of all, you have a growing dividend plus some special dividend being paid along the way. So there's little to hate about Costco when you look at this type of dividend triangle. And then you can ask yourself, how come this company is able to generate such a stable revenue, earnings, and dividend growth throughout every single years? So the first element to answer this question is, of course, to look at comparable sales. Why comparable sales are so important? Well, because they tell you how each stores is doing versus the year before. So it's not about opening new stores. It's not about making acquisition. It's just about getting more traffic, increasing the sales, and increasing the ticket per customers whenever they come into your store. As you can see here, we have a steady increase in sales and a steady increase in traffic. So more consumers spending more money, and this fuels a lot of recurring growth for Costco. Then, this recurring growth is actually fueled by their membership model. So in order to be able to shop at Costco, you must have a Costco card. It goes with membership, and then you have to pay for that membership, which is even better because it means recurring revenue for Costco. How recurrent? Well, 90% of members are actually renewing their membership every single year. That's actually even better than Dividend Stocks Rock. That's kind of crazy. We even see that the growth of that membership is not about to slow down because we have 7.6% growth over the past 12 months, which is kind of crazy. So this is how they are able to actually drive more traffic into their stores, is just by selling more membership cards. Finally, the other growth opportunity Costco has is there's still a lot of market to capture. So they intend to open new stores in the US, in Canada, and also internationally. Actually, I think there's even more room for growth on the international market, but since they're still opening new stores in North America and still being quite successful, I don't see why Costco would take the risk right now to spend more money on the international market when they have not developed their own market already. So what's the problem then? There must be something crazy here if I tell you that maybe 2025 will be the year of the crash for Costco, right? So the problem with Costco is actually called PE expansion. So, a classic way to determine the value of a stock is to look at the price earning ratio. And this ratio keeps going up almost every single year, especially since 2020. So this company used to trade at roughly 30 times its earnings, which is already quite expensive. So between 2015 and 2020, that was pretty much the range that we had. But that, as of late, we crossed the bar of 40 times the earnings, crossed the bar of 50 times the earnings, and now we're getting close to 60 times the earnings. Is this something that is sustainable? Well, let's take a pause and see why PE expansion is so important and, most importantly, so dangerous. So at the end of the tech rise, right before the tech bubble, Microsoft used to trade at more than 50 times its earnings. As you can see on this graph, you see that the PE ratio since then started to slow down for the next 10 years. So between 2000 and 2010, what we see on this graph is the PE ratio keeps on dropping. The price was almost dead money for the full 10 years. And in the meantime, earnings per share keeps on increasing. So how can you explain that even if Microsoft was making more profit per share every single year, the stock price was dead money for 10 years? Well, it's quite simple. If you bought it right before the tech bubble burst, you were paying way too much for that company. So the PE ratio was way too high at one point. Microsoft benefited from a large PE expansion back then, and then everything went back to normal. So now let's switch back to looking at the same graph for Costco between 2015 and 2025. As you can see on the graph, of course, PE ratio keeps on increasing, and now we're trading around 55 times its earnings. In terms of the stock price, well, of course, the stock price kept on skyrocketing, making a lot of shareholders smiling, including yours truly. At the same time as well, the earnings per share kept on increasing, but just not fast enough to justify the increase in the valuation. So if you had an EPS that doubled and the price doubled, then the PE ratio remains the same. But if the EPS double and the price quadruple, well, then you end up paying a lot more for the same company and for the same profit. So while there is an obvious risk, what can you do right now at this time? And should you buy Costco if you don't have it in your portfolio? Let's take a look at the dividend triangle, but in terms of numbers this time. So looking at the past 5 years for revenue growth, earnings growth, and dividend growth that is being provided by my membership, Dividend Stocks Rock. As you can see here, what I find very interesting is while the revenue and the earnings are growing double digit, the earnings per share is actually growing faster than the revenue, which is a pretty good sign. It usually tells investors that the company is able to grow their margin. So by improving margin, you will make more dollars of profit for each dollar of sales, which is exactly what you want as an investor. So there's some kind of like a justification here to maybe increase the PE ratio, but not because the market is overhyped, but maybe because this is the right way to value Costco today. You will often hear me say that Costco is priced for perfection, but there's a reason behind it is because Costco is operating a nearly perfect business model. The company shows a great combination between organic growth and recurring revenue. It is also quite recession resistant, mostly because the revenues are being driven by members that have the ability to pay for a membership and buy in bulk. In other words, they are making a higher salary than the average American and average Canadian, which make them less impacted by recession. The fact that they are improving their margin thanks to the Kirtland Signature brand, which is their own brand, so it means that they sell their own products, is also a great sign of higher profitability to come. Finally, they still have plenty of growth opportunities on international market, and they're definitely not done opening new stores. So I can see a lot of high single digit to double digit growth going forward, and this is probably why the market is so excited about Costco's business model and willing to pay a premium for this kind of quality business. So should you buy Costco today? Before I answer this question, I invite you to download my Dividend Income for Life guide at dividendstocksrock.com/income. This guide will explain you what's the difference between the low yield and the high yield stock, and actually the fact that the low yield companies with a higher growth potential is a lot less riskier even for retirees when you build your portfolio. There is also an example of a full retirement portfolio there that could help you retire with a better dividend, a better source of income, and something that will help you sleep well at night. So going back to Costco, well, if you are about to enter in a position today, probably that you should be prepared for a few bad years. I strongly believe in the company's growth opportunities, and I'm cautiously optimistic regarding the price. It is one of the rare cases where I look at the price, I look at the PE ratio, and I feel a bit uncomfortable right now, but since I bought it at a pretty good price, I still want to ride this wave, mostly because I think the growth is not over yet. However, the best case scenario would be to see that the stock price does not move for a year or two, so earnings per share would jump by a good 20%, bringing the PE ratio to a more reasonable numbers around 40 times the earnings. Even then, a lot of investors will tell me, Mike, 40 times the earnings is way too much. On my side, I'm willing to pay for quality, especially when we're talking about recurring revenue quality business model. All right, guys, that's enough for today. Do not forget to subscribe and like this channel to help me spread the love across the dividend investing world. I want to see you in the comment. Let me know what you think of Costco. Do you think it's overvalued? Do you think that there are better opportunities on this market? So I'll see you there. And until the next video, don't forget to stay invested.